right. All right. Always a great day for everybody out here. Mr. Patel, how are things for you, my friend? November 7th, 2024, 2 days after the election.
I just woke up. I could use some Dutch bros, bro. Could use some Dutch bros.
They need to sponsor the channel. That's what I do know. 150%, because at this point, it was an interesting conference call. We can touch on that a little bit later if we so desire to, but which it was actually a pretty interesting conference call. I listened to it on the drive in this morning. But nevertheless, everybody, if you are in the comment section, you are not subscribed, you will not be able to participate in the chat. So please go ahead, subscribe. It's completely free. November 7th, 2024. Interesting past few days in the market. Let's do a quick rundown. Apple, 227. So that one hasn't been skyrocketing like everything else, but Amazon's at 210. The bros, as Mr. Patel alluded to, hit almost 50. I think it actually hit $50 at one point today. It's retraced to 44.65. Google 181. Palantir 55.79. Believe it or not. SPY just below 6,000 on the S&P. Q's $513. Bitcoin $75,764. Oil below 72, and Henry Hub gas $2.70. Mr. Patel, what surprises you the most over the last 2 days of this insanity that we've been able to catch? It's been wild.
Yeah, I mean, it's nothing surprising me. It's just, it's an evolving thing. I definitely did not think Trump was going to win. I really thought abortion was going to be the pretty much the kryptonite for him. So, but then again, I guess I was wrong. People care more about policy than they care about this one thing. So yeah, a lot of the one like weird thing though that I keep seeing is all these like super liberal woke people like coming after Hispanics. It's like you bunch of traitors, and I was like, what? Like, yo, what the hell is wrong with y'all? Like, you guys coming kind of hard on. I think it's Hispanic men in general, because I think Hispanic men might have voted majority for Trump, and so it's like, dude, it's pissing them off like crazy. So,
well, yeah, the African American vote actually for men, it didn't change so much for women, but for men, it went from like 11 or 15%. Republican to like almost 30%, almost 40% in most cases. So that helps swing, coupled with the Latino vote. Yeah, I think that's really what drove it home. Interesting, but I was surprised to only see 67 million compared to the 85 million that we saw under Biden voting. So curious to see what ends up happening with that, if there's going to be any investigations. So anyway, other than that, I'm just kind of curious. Let's hop open our portfolio, Mr. Patel, and see if there's anything crazy going on. Let me just get this into slideshow mode. Let me know if you can see everything well and good. Yes. So this once again is organized from highest value up top to lowest value down on bottom. So the whole portfolio at this point is about $5,700. We added another $100 or so the other day due to the money that we got from the channel. So thank you guys for that. BPYPN still the largest holding at about 30%, and NEXT is 21% of the portfolio. So we're doing rather decent with those two positions. Vornado is the third largest at about 15%. That's about flat, but it is mostly due to dividends eventually coming through, hopefully. And then maybe when interest rates start to go down, we'll see a little bit of a growth piece associated with that. BPYPM, 12%. Carnival and Norwegian, about 5% respectively, but both those are up about 55 and 61% respectively. Bitcoin, we have a small position in that, about 2.5%. That's up about 19% from when we started loading that. HIMS up 76%. Wow, holy shit. And then China started to come back today, actually. I was pretty surprised to see that. So FXI, even though it's only 1%, 2% of the portfolio, started to come back a little bit. Celsius is still way down. And ABCL way down as well.
You know, one that's shocking me right now is VNO preferred. Okay, so go to the VNO stock. Okay, just regular plain common. And it's hilarious to see this because technically this is not supposed to happen. You're not supposed to have common equity rallying hard, but the preferreds like standing still. I mean, then again, the value in the preferreds might be already kind of like tapped a little bit, but this is Vornado and this is their common equity. Okay.
It was the past 6 months, 85%.
Yeah. So if you go like the past, like let's say, I don't know, 1 month, you can see that there's been a dramatic upward movement, right? Like 15%. But when you compare it, so go up there to compare. There you go. And just put VNO PRL or VNOL. It'll be VNOL.
Dash L.
There you go. Yeah. Yeah. So you see that? That's a bit disconnected. So
that's on a 3-month basis. Let's check on a 6 month. Yeah, on a 6 month, it's even worse. 20% versus 88%.
Well, the thing is, like, I have a couple of reasons why that's definitely like this is happening. Number one, Vornado's common equity was just beat up so much. And so the possibility for total capital return is higher in VNO than VNOL. Because VNOL, remember, the par value is 25. But that also means that I thought the 18 would end up going to 25 in the short to medium term, but it hasn't really moved much. So it's just very weird to see that. But then, you know, I think this is like the time where you have to look back and look at like the 10-year treasury and see like, okay, who are the main drivers behind preferred shares? And usually it's, you know, people that are a little bit more sophisticated when it comes to not sophisticated, like in terms of investing. Like, I hope people don't think that like, oh, what are you saying? Like, just because I don't buy preferred shares, I'm some kind of like Neanderthal. Like, no, it's just the people that traditionally buy these are usually large funds or usually bigger names that are out there, like pension funds and stuff like that. So common is where most retail investors tend to buy stuff. So if you go to Robinhood, you'll be able to buy VNO, but you're not going to be able to buy VNOL.
Right.
So I think that could be something to also consider too. So retail primarily sticks to more like common equity stuff. So with VNOL, you're getting a 5.4% yield face value on this thing. Well, on face value, it's 5.4%. And then on like, because what happens is if you buy at 18, you're buying under the face value. So the yield is going to be more. So the yield is like 6.5%, 7% right now if you were to buy this, right? Which is good. But when you compare it to the 10-year treasury, the 10-year treasury benchmarked against this is almost like 4.5, like, or a little bit less than 4.5. So the amount of risk that you're taking is actually better for TLT than it is for VNOL. So that's why I think we are seeing this kind of like momentary weakness. Otherwise, it should eventually recover. So we'll see.
I think it's because it's not like it's an 8 or 9% yield, right? For the par value, it's 5.5, right? So in that respect, it's not like you're competing so drastically right now, right? And I think if we were in a different situation where we were on our path towards 3% interest rates or something of the like, then you wouldn't have seen that curl over, right? You could see as soon as we started to see the 10-year go the opposite direction in the middle of September, you started to see this kind of flat line. So I'm still cautiously optimistic, man. I mean, we might have to wait a couple months, but it'll continue to move in the right direction over time.
Yeah, and while we wait, we're getting paid. So it's not like we're just sitting on dead money by any means. You know, all that money that we get paid from it just gets reinvested. It just sucks because it is one of our larger holdings. I think it's in the top 3. And the thing is, in terms of total capital appreciation, it acts like a drag on the rest of the portfolio. But, you know, I mean, you're going to get those, I suppose.
Yeah, you're going to get those.
Portfolio again. Let's see. Yeah.
Yeah, so it's the top 3, 15% holding. So it has dragged a little bit. But, I mean, thankfully, we have 10% of the portfolio just absolutely mooning with these cruise lines that I didn't believe you about. But we made a, you know, I'd say I made a mistake. I mean, not in my personal portfolio, but in this portfolio, I sold Rocket Lab too early. And I think I sold it when it got to like the $8 or $9 range, and it's hitting mid 13s at this point. So in terms of my personal portfolio, that's obviously done extremely well. But from from what we could have been having. I mean, granted, I don't know what we bought instead. It might have been VNO, it might have been something else, but it's not like we're hemorrhaging cash. And the only thing we are hemorrhaging cash in are these really small positions in Celsius and ABCL. And so I'm still waiting for Celsius. I don't think it's down and out. I just think it still needs to consolidate and eventually it'll turn around. But I just don't think for me, it's not a position I'm trying to absolutely pound into my portfolio as of yet.
Yeah, I mean, dude, when me and a lot of the people on the Patreon got into this thing, it was worth like $2 at one point. I'm up about 600% on my Carnival positions, Carnival and Norwegian. So it was pretty good. We'll see. So let me answer something. So someone at the bottom is asking, are you guys buying more at these prices for Celsius and Accelera? So, this is one of those times where you have to look at your portfolio and just see what's working and what's not, and ask like, why isn't this working? And does it deserve to be a bigger part of my portfolio? So if you look at Accelera is a great company, but they are still not generating a crap ton of revenue. They don't have any drugs in the market, so they don't have any revenue. They're still waiting in clinical stages. They're burning cash, so probably not the best time to be in it. Like unless you really have like super high conviction, then yeah, you could be in it. Like I haven't even been DCAing into it that much lately because it's just been at the bottom, and I'm like, look, I have other places where I can stick my money. And Celsius, based on its last earnings, is also slowing down significantly. They did have some positivity in their international growth, but their revenue came back super, super bad. And I feel like it's going to be a temporary move down and eventually it will recover. But, like I said, there's other opportunities in the market where you can make money. And so I'd rather be in that than trying to wait for this turnaround to happen. Because remember, everything, I think what it is it's opportunity cost. Right? When you're sitting on something that's not growing and that's actually going down, you're missing out. And that opportunity cost is something you really have to be careful with, because otherwise it could be a serious drag on your portfolio. And I know people are going to come at me and say, well, that's a trader mentality. You're not a long-term investor. And I'm like, it depends on your definition. Like a good example is something we could talk about is Enphase. Remember? So people were egging us like, buy Enphase. Enphase is the future. Solar is the future. And I'm like, no, like I don't see it. I didn't see it. So it's one of those times where you got to buy what works and what doesn't. And when I looked at Enphase, I was like, there's two things that Enphase needs to succeed: low interest rates and high natural gas and utility prices. You combine those two things together, solar absolutely skyrockets. Right. Neither of which we have right now. We don't have lower interest rates, right? And neither do we have high energy costs. So people are not exactly going to go out there and say, yeah, let me put like a $20,000, $30,000 solar system roof when my or electric bill is like a couple of $100 a month. Like no one's going to finance $700 to save $200.
Yeah. No, I think a lot of times they'll be like, oh, I broke even. It's just like, did you actually though? Are you actually using discounted? You know what I mean? Like if you could have invested that money at 6 or 7% into the market, did you actually break even? Or are you just using straight dollar for dollar, right? Not including inflation, not including any of that stuff. Like, are you actually doing an appropriate capital value assessment on investing in that piece of material? But going back to what you talked about, I mean, I'm putting $25 a month, $25 twice a month. So basically $50 a month into Accelera. Who knows what happens? But I want to take a step back because I don't think a lot of people even remember. We weren't thinking that Celsius was going to absolutely explode. I mean, did we think it was undervalued? Did we think it had momentum? Yes, but what we ended up seeing was several years worth of anticipated growth within the matter of a couple months. And so at that point, you just got rid of it. You know what I mean? Like, I think that initially the thought was 18 months to 2 years for it to kind of get to the pace where we initially thought it was going to get to, which was 75, 80, maybe $90. But the fact that it absolutely skyrocketed that quickly is why you shifted out of it, right? So, I mean, I don't think necessarily that people understand that it wasn't necessarily a trade in initially, and at least from my perspective, what ended up happening is it just started moving so quick from the 40s to the 50s to the 60s, 70s that it just ended up that way. And sometimes when you get the opportunity, you just have to take profits, right? And depending on what you're doing and what it is, I mean, I wouldn't be surprised if you see something like that happen with Palantir, right? And hopefully people, I don't want to say sell Palantir because I think it still has a long piece ahead of it, but you're paying for what at this point? Like fiscal year 2029 earnings? Like it doesn't make sense for some of these opportunities that are out there. But then again, does that matter, right? Is it really that once in a lifetime opportunity like Nvidia, and then it doesn't necessarily matter if you're paying for fiscal year 29 or 2030. It just matters that you have the stock and you eventually grow with it. So it really just depends on where you're at. But interesting sides to what's going on. I mean, do you think that really it's warranted for all these positions, not in our portfolio, but just in general, all the market and everything of the like do you think it's warranted that the S&P 500 is eclipsing on 6,000? Do you think that it makes sense for all these other companies to be up 10, 15% in the like JP Morgan up like 15% the other day? Like, do you think that that's warranted just because we think that there's going to be some potential corporate tax cuts?
I don't think it's just corporate tax cut. I think it's a more lenient like business policy, so overregulation is a real thing. And the thing is, like, when you have overregulation, it acts like a drag on earnings. So, guys like Trump are coming into power and saying, look, not only will I cut your, taxes, but I'll also cut that red tape that sits in between you and getting to the end goal, which is make more money for your shareholders. I'm kind of either in it a little bit, but I'm also not in favor. I think the thing is, when it comes to banking, especially, the more regulations you take off, the more likely it is that you are taking away something that could be protecting the average consumer. The way that capitalism works is that it's very blind. It could be used. Capitalism is like a weapon. It's great if it's in your hands, but it's terrible if it's in the other guy's hands. So the thing is, a lot of these regulations kind of like even out things and like make things fair. And by taking away certain regulatory frameworks, you might actually be hurting the average consumer. So I don't know. It's something to be said where you have to have the right balance between regulation and overregulation. I mean, you work in the energy sector, so you see what I mean. Like, energy is very regulated. And so there are times where the regulatory environment prevents the actual development of energy to the point where it causes these wild movements in energy prices going higher and lower, right? Whereas if you had just not regulated so much and just left it to the industry, you could probably see a lot less fluctuations, because the market would determine production, not necessarily the regulatory changes that are constantly being changed. And it's weird how often some of these regulations are changed. So,
yeah, I do think that that's something. I mean, specifically from an energy environment, I think you're right. There was definitely a difference when the Biden administration took over. And even I saw that when the Obama administration transitioned to the Trump administration. I mean, the ease of being able to get small things done was very interesting. Granted, it might be exacerbated because I am in the oil and gas industry. So in that respect, with a more liberal administration, it might be a little bit more of a shadow amongst that particular industry, but I could see it with a lot of different things. But crap, what was I going to ask? I'm curious for you, what of the stocks, because everything's been mooning, what of the stocks in your portfolio has been performing the absolute best? What's the one that's most surprising for you, knowing what we've seen over the past 2 to 3 days?
Well, there's a couple that did really, really well in the short term that are worth talking about. The whole next decade trade has been great for me because I'm up nicely on that. Other than that, the cruise lines have absolutely been killing it. Norwegian. I have so many spreads on the cruise lines. It's like, like if it gets to what I need it to go, like Maddie, we good. Like I'm good financially forever, you know. So the cruise lines have been doing good. That's been doing good. And recently, the last couple of days, China's been slowly recovering as well. So with the US cutting rates, it's helpful that it's moving in the other direction as well. So the Chinese are more likely to keep cutting. I mean, let's look at Shanghai right now. Let me look at how that's coming off.
Yeah, while you're pulling that up, I'm curious because it's been about a month or two since we talked about it. Have you started reaccepting folks into the Patreon, or are you still
Yeah, I
on
have.
hold?
I opened it up a little bit just to because I know quite a few people had to change some what is that thing called? Change their billing. So I said, fine, you know. So the problem is if you kind of lock it down, people can't change their billing, and sometimes people want to move up tiers and down tiers. So I said, all right, whatever, just leave it open. Let them do their thing.
There you go. So yeah, if anybody's interested, feel free to check out in the description below Mr. Patel's
the Discord community is pretty awesome. Like I love it. Like people have really good conversations on there. Yeah, it's just there are times where it can get a little overwhelming. So it's one of those things that like people will either love it or hate it. But I try to be as active as I can be and try to address questions when I can, and you know, just try to identify opportunities. Yeah, and a lot of times what happens is we're able to do a little bit more deep analysis on the Discord that we may not do outside of it. Like I don't want to regurgitate next decade again, like publicly. I'm just if you want the information, the lowdown, just join the Discord. You'll like it literally is an entire thread on this whole thing. Cause like it's literally every other day. There's like new moving pieces that are constantly being, you know, constantly evolving and being.
Chris, it went up 10 cents. Is it still okay to buy? Chris, it went up another 5 cents. Is it okay to buy?
Yeah, I know. That's when I'm a little bit like, oh, dude, like it's the thing is like it's all about perspective, I guess, you know. And that's the thing that you have to always remember. And I think that's hard to explain to people that there are things that are worth holding on to long term, and there's things that you want to just kind of like have this unique singular trade. But then there's also times where things get a little too haywire, in which case you kind of want to get out too. So I don't know.
Yeah, same thing kind of happened with Rocket Lab, right? I mean, definitely was talking about it a good bit, and then nobody really wanted to pay attention because they thought it was Rocket Mortgage, and then it, you know, doubled in price. And they're like, oh my God, these mortgages are selling off the hook, right? And so they're like, oh wait, they actually launched rockets into space too? I didn't know Rocket Mortgage was so versatile. And then you know, people are like, Matt, it's $8. Should I still buy? Matt, it's $9. Should I still buy? I'm just like, I can't tell you, man. You know what I mean? Like at some point, I don't know everybody's financial situation. And that's the thing is like, I think that you and I talk about it a good bit. Like you need to recognize to an extent where your own financial situation is compared to yours and myself. And for me, it's like, I still buy Rocket Lab. Like I think I bought $400 yesterday just because I had $400, you know? Because, you know, for me, I'm not looking to sell it tomorrow, you know? And I think that the longevity of it, just same thing with what we talk about with NEXT, it's like, okay, so it's gone up a little bit. Like, am I still going to not buy? I think I bought like $300 today or something like that, just because. So I mean, it just depends on where you are, where you think it's going, and that conviction and your risk tolerance too, right? Like if you don't want to see a dollar loss, like I have some people that like if they see red, they freak out and they sell immediately. And then I'm like, dude, they ask me like the next week they'll ask me like, what should I buy? And I'm like, I'm not telling you to buy anything. Because if you see red and it goes down 5%, you're going to sell. Like I had a buddy, he sold Google. I forget when this was, but I was just like, he told me he sold it. And I was like, that's going to be the biggest regret of your entire life. Because I think he had like 250 or 300 grand in it. And I think he saw it go down 5%. And I'm like, you have no long-term vision. You have no long-term conviction. I was like, you should honestly just be one of those people that just puts the money in the S&P 500 and just forgets about it and checks in 10 years. And I was like, and that's okay, but just acknowledge where you are within and how you can handle things. Because I'm okay with understanding that piece of the puzzle and understanding and being okay with stocks pulling back a little bit if I can completely understand and know that underlyingly they're going in the right direction. So you were going to pull up something?
I was not really pull up anything, but I was going to say Chaos Perez. He asked like, so in order for me to what was it? What do you say? So in order for me to be a better investor, I need to learn how to do call options and spreads. Honest question. So,
Yeah.
okay, yes and no. Let me explain why. Options give you this ability to either accelerate or put put on some brakes, right? So right now, when it comes, the way that I always think of it is like you're driving a car, and imagine you didn't have any brakes or you didn't have an accelerator and things are just going in a steady direction, right? You'll get to your destination, but there are times where you kind of want to put a little bit of brake on and you want to hit the accelerator a little bit. And so when you see things that are like very, very mispriced and undervalued, and the risk to reward, you want to like take the chance, you can buy some options and those things will just skyrocket, and it'll give you the ability to lever up your conviction much higher, right? So I love options for two reasons. Number one, you can take a little bit of money and use it to lever a lot. And what's good about that is that if you look at it from a risk perspective, right? If let's say you took a $50 bet, and the bet that you're making is, hey, this stock will go from $50 to $100. You actively have to put in $50, right? Now, if you do options, you could buy a contract that costs $10, right? And say, hey, I think this option is this, the stock is going to go from $50 to $100. If you buy the call contract, what ends up happening is you're basically paying $10. And if it goes up to 100, then you're making 500% return, right? So that's amazing. Like you could actually do that kind of crazy return like that. So there is huge ability to leverage up. And from a downside perspective, all you're really going to lose is $10 if it doesn't work out. Now, yes, there's something to be said about timing and all that other stuff that you also have to factor in. But if you know what you're doing on the option side, it's a good way to lever up and take positions in things that are going to work out and not work out. So it's one of those things that, like, as a small retail investor, we have a little bit of advantage when it comes to options versus like the institutional funds like hedge funds and all these other guys. And even the hedge funds utilize options. So it's not like, oh, it's just a retail thing, but options are great in that they will allow you to basically, like I said, put the brakes on or hit the pedal harder. And you could, use it that way. The other way is, of course, you can buy some puts as protection. So it's like buying insurance. You can also turn this into an income generation ability by selling call options, like selling insurance, like TJ does. Like if you look at TJ's portfolio, he's up like 60, 70%. And this guy, all he does is sells options. He just sells puts, sells calls, all that good stuff, whatever. It's not something that I utilize. Like I'm not a wheeling guy. It doesn't work for me. But for TJ and his temperament, it works. And it's paid him a good amount of money. So I think it all depends on your risk tolerance, your ability, and your willingness to learn. The one thing I will say is you have to be a lot more active when it comes to option, like in terms of like a trading mentality when you're doing options than when you're doing just plain stock.
Yeah, you
I'll give you
can't
an
just set it
example.
and forget it. Yeah.
I'll give you an example. Like I bought Celsius about maybe a month ago, like call options on it at 45. After earnings, I sold it. I was like, whatever. The amount of time that I have on these things, plus all the time that's going to be required for these guys to make a turnaround, and the total return potential that I have based on its current earnings estimate and what the earnings estimates are going to look like in the future, the risk to reward didn't seem appetizing to me. So I sold it. I took a loss. I took a $20,000 loss. But $20,000 loss was against, hey, I have hundreds of $1,000s in gains in these other companies. So
Right.
you have to be willing to stomach those losses, but then also remember you have to count them against your gains as well. And I think that's the other thing too. Like when you do options, you want to make sure you're diversifying your positions so that this way they're all working out. And the best piece of advice I can give when it comes to options is, especially if you're doing long contracts, if you do straight stock, let's say $100, and you only do one, like you're betting that one stock is going to double, right? So you're basically putting $100 in one company, and boom, now you got to wait. Now imagine instead you did an options contract with 5 different companies that are all worth, let's say, $100, just to keep it easy. So what you're doing is essentially taking 20, 20, 20, and 20, and 20. All you need is one of those companies to get to that 5x mark, and now you've basically made all your money back. So if the other 4 go to zero, you're fine. Like you're still going to be fine. You're breaking even. If 2 of those companies make it to that 5x mark, you're going to end up doubling your money. If 3 of them get there, you're going to triple your money, right? Now, usually you'll never see like all 5 of them hit unless you're like a super, super great investor. Like I don't even hit 5 out of 5 like companies like that. I do hit enough to the point where my total return is amazing. And I account for that, yeah. So it's just making sure that you've got, some level of risk management, but then also you're diversifying the risk. Because that's the thing. Like if you diversify the risk, your total return could be substantial, So
I think the biggest problem with options that I see a lot of people think that it's sexy. People think that they want to know, they want to get involved. They think that that's the way to do things, and it's not always the way to do things. I mean, I see a lot of people being like, "Ooh, I want to get in this stock, so I'm gonna sell a put." It's just like, well, if you really want to get involved in the stock, buy the fucking stock, right? Or you know what I mean? Like if you really want. So I think they sometimes use the wrong tools, and that's the thing with options is like it's not as simple as buy or sell or short, right? It's also the fact that you, like you stated, you could use it for income, you could use it for leverage, you could use it for insurance, and so with that, sometimes people are doing things when they actually meant to do something else. And so it's almost to the point where they're like, ooh, I would really love to get into, let's say, Rocket Lab at $10. And so they'll sell a put on $10 and then they get upset when the stock goes to 15. It's like you used the wrong tool, right? Like you said from day one that if it went to $10, you'd be willing to buy, and this is the amount of income you'd be willing to generate from that as premium to be able to accept that contract. Well, then you can't get upset if it never hits that point because you already made your money, 100% of your money day one, and you use the wrong tool. And so I try to explain that to people a lot of times. They're like, I should have just bought the stock. And I'm like, well, I'm glad you learned your lesson, because I think a lot of times people are like, ooh, I need to wheel because it sounds sexy. But in reality, it's like you have to understand what you're actually doing it for. Wheeling is an income generation tool. And sometimes you might get lucky. Like TJ doesn't always wheel. If you think about it, TJ also buys long positions in stock. And, so he has SoFi, he has Palantir, so he's not always generally just wheeling. There are stocks that he's always wheeling underlyingly, but you have to think he also holds equity positions. And the reason why his portfolio is absolutely going upwards and to the right is because of those equity positions, not because he's wheeling the stock. Right. He gets income from that. And you have to think also that when you do that, you're most of the time generating short-term capital gains, and you're going to pay higher income taxes on that. You're not going to be paying capital gains taxes or dividends taxes on that. So if you're in a 35-40% tax bracket and you just made $100, well, at the end of the year, you're going to owe the tax man 35 or 40% of that. So I think people don't necessarily know, and I did the same problems as well, right? Like I say this because I've been through that experience, and I want people to acknowledge the fact that you get smart enough to be dangerous to yourself, but not knowledgeable enough to recognize that you're harming yourself in the long term. And so I'm not saying don't wheel stocks. I'm not saying don't buy options. I'm not saying don't sell covered calls. I just think that oftentimes people will try to chase pennies and end up losing dollars because they're not necessarily thinking. And I do it all the time still, right? Like I'll sell covered calls and I'm underwater on something, right? Like Dutch Bros. I sold a $39 covered call thinking there's no way it would go to fucking $50. And here it did pop $50 today. Now, luckily it retraced down to 45, but I'm going to be stuck rolling that for a couple months, like, and maybe it'll come back down. But at the end of the day, you need to you can't go into things haphazardly. You really need to, especially with options, understand not only the entry point, but also the exit point and why you're getting into something.
And timing, because timing is a lot more. When it comes to options, timing is way, way more important than just buying and holding a stock. Because you do have, like, here's an example, like Next Decade. Someone that I know bought a ton of call options on Next Decade. And I said, why? They're like, well, like this company could do really well. I said, well, the stock is trading at like $5. And you paid like $2 for a call contract that expires in 2 years on a company that's dealing with, all the bullshit that it's dealing with. It could go to $100, $200, eventually, right? It could even double tomorrow. But literally you're paying half the price of the stock in contracts. Don't do that. Just buy the stock outright because there's no time limit, you know? So a lot of times what happens is people will buy things when the IV is super high and pay a shit ton in premium, and then the theta will decay. So over time, the position will decay on them. And it's like, oh no, what the hell? Like, how come the stock is going up but my options position is going down? And it's like, yeah, because you bought when the thing was a little too high. So it's one of those things that you deal with. One other comment that I think that guy John Doan is saying, wheel options in your Roth IRA, tax-free income, but also no tax long-term. Yeah, that's true too. You can wheel in your IRA and you can do it in your traditional. The traditional you're not going to be able to touch really. Even the long-term you're not. I mean the Roth you're not going to be able to touch into the future. But yes, there is no taxes. But there is one downside to both of those things, and that your capital is limited by how much more you can put in. You know, there's caps every year, how much you can put into your IRAs. So unless you have a meaningful position, you're not going to be able to really like make a ton of money, doing options. Because that's the other thing too. You need a pretty big bankroll when you're doing, when you're trying to wheel options for income, quote unquote. But like I said, even that, I don't know. I think of all these different things as tools under my belt. I use bonds. I use preferred equity. I use stock. I use options. Hell, I'll even do like other things like non-traditional things like triple leverage ETFs once in a while. Like you saw in the summertime when everything collapsed, we bought some triple leverage. What did we buy? Triple leverage QQQ? Remember? And that thing ran up and then we sold it and we made a little bit of money. We took that money, reinvested it back in some of our other higher conviction things. I mean, everything in the market, they're just different tools out there. And it just becomes like, hey, you need to learn how to use these specific tools to get to your end goal. Right.
Yeah.
And do it in a way where not only is it tax efficient, because, the last thing you want to do is make $100 and 40 of it goes to Uncle Sam or 50 of it goes to Uncle Sam.
Yeah. So I want to talk about that because this guy thinks that I'm pulling like wool over his eyes. So if you make 200 grand a year and you sell an option and you make $1,000 on that option, you're going to be paying $350 of that profit to Uncle Sam. And regardless of whether you think it or not, you might be talking about progressive. It's like, we're not talking about the entire $201,000 that you made. We're talking about that going from $200 to $201,000. You're paying $350 to the tax man. And if you think I'm lying to you, go see a tax accountant because I'm not lying to you, my friend. You will be charged $350 for that if it is not in a taxable tax advantaged account. I'm not lying to you. Like, I'm trying to help you people. Like, if you look at it from the whole scale of things, you might be like, oh, well, my effective tax rate for the whole year went from 24% to 24.1%. It's like, yeah, but that last dollar that you made was taxed at 35%. So if you make $1,000 trade and you sell in short-term capital gains and you take a profit of 10 grand, you're going to be paying $3,500 to the tax man. I'm not lying to you. And
then also you have to remember that state income taxes come into picture also. I mean, unless you live in Texas or some of the other like Tennessee, Florida, Washington. No, not Washington. What is it? Some of the other income, because remember, it's based on ordinary income. Those are the ones that you're going to be free from that. But if you live in California and you do and you're already making like, let's say 300,000, you're like way up there anyway. So any incremental dollar that you make on top of that 300, now it's going to get taxed at a 35% rate by the federal government. And then you're also going to have on top of it the state and local taxes that are going to add up to it. So, that's why if you look at some of these guys like that are content creators, they've all moved to Nevada, which doesn't have an income tax, Like, what's his name? Jeremy doesn't have any income tax.
And that's why a lot of them, when a lot of them moved, like the real estate guys, they were all just focusing on where can I go where I don't have to pay 12% in state income tax. Because then again, if you're making another $1 million, not only do you have to pay 40% of it to, let's say you go from 1 million to 2 million. Somehow you sell something, short-term capital gains, market goes to the moon, and you sell it. And now you have $1 million short-term capital gains. You're going to pay 40% of that to California. Sorry, to the federal government. You're going to pay 12 or maybe it's even 13% to California. So, I caution you to not necessarily say don't do it, right? I'm not saying don't trade stocks or don't sell a position because of tax. Like tax is inevitable, but don't be stupid when it comes to taxes is all I'm trying to say. And I think a lot of times people are too lackadaisical, and then there's some people that are too fearful, you know? So just be sure that you're not making stupid, silly mistakes.
Yeah, I mean, I've had some positions that are like really appreciated, and I want to sell them, but I'm also like, man, do I really want to like pay 40%, or can I just wait like a few more, like a few more months? In which case, if I sell it, I get the preferred 20% at the top, in terms of long-term cap gain. So I'm saving myself a crap ton of money because I'm already at, like, between me and my wife and our W-2 income and our income from other sources, it's way above that. So now I know that every incremental dollar is going to count against me. So like I said, you have to learn about taxes too. Like, investing is not just investing in companies, but also figuring out what your tax situation is. And then, and then willing to, like I said, it's like, if you make 1,000, you got to surrender 50% of it. Your total return is just 50% because you had to pay the taxes on it.
But
that's
I think
why
another thing that I want to highlight is, like, I think a lot of people when I was in my early 20s and late 20s were laughing at me because I didn't save as much in my 401k. I did the company match of 7%, and they're like, "Why aren't you saving, $20,000 a year in it, bro? Like you're letting go of your tax break." It's like, well, guess who has $1 million in liquid that they can do whatever the fuck that they want with? That's not in a retirement account, right? It's not in an IRA. It's not in a 401k. And if I really need to wait and work the next 20 years and boost up my 401k, I have it. But say I want to go into real estate full time. Say I want to open up a business. Say I want to start day trading and doing what TJ's doing, wheeling and dealing stocks. I can do that. Versus if it's in a 401k and it's locked up, you don't have that opportunity. So I'm not saying that what I did is appropriate, but I also saved, in some cases, over 50% of my income some years. So to me, if you think about it, I'm not just saving the 10 to 15%. And granted, I am a special case, I guess. I don't have kids. I don't have this. I don't have that. But like, dude, 33, multimillionaire, can do whatever the fuck I want with a lot of the money that's in there. I think like 75% or 80% of my money is outside of retirement accounts. Like, if I wanted to go do something with that money, start a business or something.
It's funny. Mine is the opposite. I would say about 50% is in retirement accounts and 50%, because I've done really well in my retirement account doing some of the spreads that I have. So 50% of my cash is outside, but 50% is in my retirement. Now, the thing is, the cash positions that I have that are in my just normal investing, those are more long-term in nature, right? Versus the other side, which is my IRA, which is a lot more like active trading and stuff like that, that helps me boost it up. So,
yeah. So, I mean, I don't want to be sitting there having, let's just say, the same amount of money if I were to put it all in a 401k, and it'd be like, well, I'm 33, I can't touch any of it. And somebody put that thought, like, oh, you can take out your contributions from your Roth and you can do this and that and the other. But it's like, then you're going to pay penalties. Then you're going to pay taxes on it anyway.
Matt, let me tell you a sneaky.
You and I talked about this the other day, Chris. You're still going to fucking pay taxes and penalties. Don't pull that shit on me.
Listen. There's a sneaky way of doing this if you want to retire early. So let's say you max out your. Okay, so I'll give you a scenario. Let's say you max out your 401k and you're a business owner and you have a little LLC and that generates income, and you basically take 25% of the profits, you put that in there. And so you really like go heavy on doing pre-tax money and putting it in there. Okay. Not Roth, just pre-tax. You build that portfolio up significantly. What you can do is every year you can take a portion of that and take it and put it into a Roth. And what's crazy about it is that, let's say you made, like, let's say a couple of $1 million in regular your regular portfolio, and you have a couple of $1 million in your traditional IRA. Okay. Now, what you can do technically is you can take that traditional money, not a lot of it, you can take a portion of it, convert it to a Roth account, to a Roth IRA.
And what happens when you do that, Chris?
You pay taxes, but listen.
But listen, the same taxes you were going to pay anyway.
No, just listen. You pay the taxes on it. It sits into that account. Then next year, you do the same thing again. And the year after that, you do the same thing again. And the year after that, you do the same thing again. The benefit, though, is that it counts as a contribution, which means that after 5 years, you can take that full amount out without any penalties. Not to mention, you get the compounding effect of all the gains that you have in that Roth account now. So like right now, let's say I have $2 million in my traditional IRA. I have $2 million in cash, and I tell my wife, fuck it, let's retire. We'll live on the other 2 million that we have in just regular investments. Okay. Now what ends up happening is that 2 million that's sitting in my traditional, I'm not going to take all 2 million of it and put it in here. What I'm going to do is the money that's in the traditional is going to be gaining, right? Let's say I put it into something that's yielding about 10 to 15% per year. What I'm going to do is I'm going to take that 2 million. I'm going to take like 200,000 of it, take it, put it into my Roth, right? I will pay taxes on $200,000. So between me, the wife, it's rarely really preferential for us to do that because there's two of us, there's married, blah, blah, blah. And the other thing is we don't have any additional income coming in because all we're really doing is just living off of that 2 million that we already have. Year number 2 goes by. We do that same thing again. And the 3 comes by, year comes again. By year 5, you can start to take that money that you put into that Roth as a contribution out and use it and pay no taxes on it because it's a contribution. It's not a gain, right?
You know what I can do to the contributions that I make to my brokerage account at any point? Take it out and not pay any taxes on it, Chris.
No, that's absolutely true. You are absolutely right. But at the same time, remember, any gains that you have on there, you have to keep paying taxes on it. Whereas the one that's more in the other side, like imagine right now, TJ had $1 million and this guy kept wheeling and dealing and blah, blah, blah. And every year he makes a certain portion of his income in his traditional. He could take that money, put it into his Roth, and now he can wheel and deal in his Roth, right? But that principal that he put into his Roth, he can withdraw it in 5 years and not do it, and not have to worry about it. Not to mention there's the impact of compounding that happens in those accounts that you're not taking into consideration also, Yeah,
I'm not.
I do understand. And Gail says it's called a Roth ladder. That's what it is. Yeah.
Well, I think, I wouldn't necessarily, what I personally would do is not really wait for the traditional IRA to have gains in the first place. What I would do is what somebody else is saying. And unfortunately, Roths, for the people that don't necessarily know, they have like a phasing out period. I think when you get to 120 or 130,000, you can't contribute any more to a Roth IRA. IRA, right? Roth 401k is different, but a Roth IRA, I think after 150 or something, you can't contribute anything. But if you were to put in a traditional, let it sit there for a week or 2 or a month or whatever, and then roll it over without having invested in anything, you might pay a slight amount of tax or something of the like, but likely very little, if anything, and then do that. But I don't know. I don't necessarily know if I would do that whole Roth ladder thing. To me, I would just rather have access to it and not have it locked up.
You just have to deal with that 5-year waiting period, and that's all there is. But it looks something like this. If you want to take a look, let me see.
I'm not smart enough for that, Chris. I'd rather just invest it in the S&P 500 for the majority of my money. And
yeah. So this is what it would look like. So basically right here, every year, like this, as an example, they would have a conversion from a traditional to a Roth, and the taxable income that they would have is 50,000, right? But they're not going to withdraw anything. The year after that, they're going to convert another 50,000 and it's going to be 0. And it keeps going over and over until year 6, in which case now you contribute 50, right? But you can also withdraw 50 and the taxable income is still 50.
But it makes it look too good, Chris, because what you're not showing is on the negative on a 4th column how much you're paying in taxes that year that you're contributing.
That's true too. But that's the thing. Like you have to know that you're retired. You're basically trickling your W-2 down. That's why I said, like,
yes. I mean, if you're retired and that's the only $50,000 you have, then yes, it's going to be tax free. Yeah. But if you're like me and you're trying to pull in $250,000 a year or whatever I make, well, I make $5. I make $5 a year, right? I don't know.
Yeah.
I don't know what I make. Let's just say $100,000. I'm going to be paying 20% or whatever on that. Like, what if I move over that 50 grand? it's now gone from 50 grand down to 40. And so it's
Yeah.
like, was it really advantage to do that anyway? Or should I have just
I mean, it's
invested it
for
in the
people.
SPY
Yeah.
and, kept it in the
I
SPY
mean,
and never sold it?
the other thing you could do also is the thing that we spoke about, which is if you get a certain amount of money in your portfolio, you could just put it into things that are just growing for capital appreciation and borrow against that thing. And you do this other strategy called buy, borrow, and die, right? Where you basically are buying at a well, you're buying something that's growing at a faster pace than the cost to borrow that capital. And what happens is you're making money throughout the difference, right? So
Right.
as an example, let's say you took $100,000 of, let's say, the S&P 500. Like you had $1 million, you bought the S&P 500. The S&P 500 has grown sixfold. The thing is, if you had borrowed against it every year, and the thing is, the cost of capital, you have to find out how much it would be. If you just borrow it, the S&P 500 is going to keep growing, and it doesn't act like a sale. So what happens is your leverage is going to constantly keep going higher, higher, and higher, and the money that you're taking out, you're basically borrowing, quote unquote, less than the money that the assets going higher. Right.
Okay.
That's another thing you could do. The only thing is you are taking some risks with that. So if you have any sudden drops in the value of those equities, then you got a big problem. So you have to really we spoke about this between me and you, like outside of this whole thing.
Yeah, I
So
mean, I think the benefit there is this, and it's actually shit. I could talk about this shit forever.
Austin's
But
like literally doing this right now.
yeah, no, I mean, you think about it. Let's just say, for example, you have that scenario where you have a SB lock or even a margin account that gives you 6%. The benefit of having that SB lock or a margin account that gives you 6% is because it's simple interest, and it's not necessarily going to be amortized interest. So technically, if you have a mortgage that's 6% and this thing that's 6%, an SB lock or a HELOC or whatever that's 6%, you could borrow, let's just say $100,000 from this, pay this thing off or whatever you want, and only be paying $6,000 a year in interest over here, right? And versus if you're having $100,000 on this, you're going to be paying amortized, all the interest up front, all that bullshit. So you can actually have arbitrage between the two. And a lot of people do that sometimes. Oh, there it is. Chris has said, I'm out. I'm tired of your shit. But you can have some arbitrage associated with that, right? Because when you think about the interest payments that you're paying, like you're forced to pay back a mortgage over time, but you're not necessarily forced to pay back the simple interest in SB lock. So
let's do this. Let's do a quick thing with Excel. Let me see if I can do a spreadsheet and we could just look at it like a calculation. Okay. So you guys can see my screen, right?
I would say I don't recommend using margin for most of it. If you actually have enough money, then maybe you can, but I would just suggest for majority of people, 95% of people do not.
So let's say we're looking at this right now. Let's say we have $1 million in stock and cash. The other thing is with SB locks, you need at least $1 million.
Chris, do me a favor and zoom in a little bit because we're not all
I got you.
520 vision.
Okay.
Like you are.
So let's say you have $1 million, right? You go and you get an SB lock. SB locks are usually a few points above the current interest rates. So right now, you can get an SB lock for about 7%, depending on the broker that you have, right? So per year, the interest that you're going to be paying on this thing is going to be $70,000. So you're saying, oh man, I got to pay $70,000. But the S&P 500 grows by about 12% per year, right? I'm just doing averages. I'm not saying that this is actually. So what ends up happening is this is going to be multiplied by that. And so your account value is going to go from this plus this 120,000. And then at the same time, you're going to minus out that 70,000 if you what is that thing called? If you just get it corrected from there. Because remember, you're accumulating debt. So it's going to get piled onto your debt, right? So just do this. And this is if you borrow $1 million, by the way. So if you have $1 million portfolio and you borrow $1 million, then what's going to happen is you can spend that $1 million, but then this is what it's going to cost you. You don't ever want to, borrow $1 million to do this. Okay. So if you're paying, let's say $1 million, like let's say you have $1 million. Let me actually do this a little bit more easier for people to understand.
SBLOC, this is what Chris is just demonstrating. It could be a HELOC, but an SBLOC stands for security-based line of credit. So let's just say, for example, let's just say it's I wouldn't necessarily do all $1 million, Chris. I would do like
let's do 500,000. Let's say you want to buy a $500,000 house, right? I'm not recommending people do this, but let's say you want to make an investment in something that's 500,000. So let me just change this to dollars. So you borrow 500,000. You have a 7% rate that you're paying on this SBLOC, which is going to be about this times that, and it's going to be 35,000 a year. The S&P 500 yields a 12% return, which means that this thing will grow by 12%. And now you've got 120,000. So your end balance is going to be, it's going to be 1 million, right? Plus this, this total return right here. So it's going to be 1.12. And of this, this is your debt. It's going to be the 500,000 plus the 35,000. So now you have this. So what is your, I wouldn't say, let's say it's not gain, net value. Your net value is actually going to be equal to now 1.2 minus this. And so your net value is 585,000 in there.
Plus before it was 500.
Right. Plus the 500,000 you borrowed. Right? Which you're basically doing, let's say, real estate or whatever, right? So that's like 500,000. Got to make it smaller, guys. Otherwise, we're all going to be lost. Okay. The year after that, now the value of your portfolio is this right here, 1.2, right? And you're not going to borrow anymore from the SBLOC. You're just going to let it do its thing. You're going to pay 7% on this, right? But you're not going to pay 7% on this, or because you're not borrowing anything. What you're going to be borrowing money is this right here, the debt value. So the next year it's going to cost you
a little bit more.
This times 7. So it's going to be 37,000. This year, let's say again you generate a 12% return. We just do 12% return. That means that now this value, multiply that by this, is going to be 134. And what does that mean now over here? What is it? Yeah. So it's going to be equal to this plus 134. And your debt is going to be 135 plus this. So it's going to be 572. The net value that you have now is actually going to be this, which is the assets minus the liability, which is right here. So 681. And the money that you borrowed for a balance sheet perspective is going to be your SBLOC plus the new money that you borrowed. So you see how your net value is going higher and higher every year. That's because you're actually beating the amount that you're paying here. Now, the good thing is if let's say the Jerome Powell and the interest rates come down, and the next year after that is like 6%, right? What ends up happening now is that the money that you owe, because the way that the SBLOCs work is that they're floating rate debt. What you are doing now is you're taking that total gain that you have, right, which is the 124, which will be here. The SBLOC value is going to be debt right there. And this is going to be multiplied by 6. So it's actually going to be less. So you're paying less than interest, right? And that year, let's say, again, you generate a 12% return.
You can just highlight everything and drag it down.
Yeah, I know. Just
sorry.
There. So now your net asset value
is just like, why?
Yeah. So now your net asset, your net asset value goes higher. Well, I don't want to lose anyone, but then
yeah.
But then
I want to show everybody something. Even if don't do it at 12%, even do it at 7%.
That's 7%. Okay.
Thank you for becoming a member, Julie.
7%. There you go.
You're still even making money, even if it's the same, because you're borrowing only at 50% of the asset value, and the total asset is increasing at 7%, while what you borrowed is being charged simple interest at 7%. So even still, you're going to be able to grow over time. So as long as now
here's the challenge that you have to deal with. Okay. And this is something that other people may not mention, but let's say right now that year was a bad year. And let's say instead of gaining 7%, let's say you're down 15%. Look what ends up happening now. Your net asset value is going to drop. And the thing is, now you're going to get a margin call.
Yeah. So I think you need 30%.
Yeah.
I think for like SPY. So they'll give you 70% of the value, I think, on SPY.
So now this is where you would have to be careful. So when markets go down, but the interest goes up, something to be careful of. So that's why you can't borrow that full $1 million. You have to pace yourself, basically. And you also have to have like a portfolio of great companies too, because no one's going to let you borrow against like some speculative names, And so if you're going to do like something like an SB lock, you don't want to do it with this. You don't want to do it with what is that thing called? With a speculative name. You kind of want to just do it with things that are more, and you typically want to keep your leverage as low as possible. That's why if you look at, like, let's say you have a $10 million portfolio, I'm not saying anyone here does, but let's say you want to have a $10 million portfolio, you can take $1 million of that and do this and basically not have to worry, because most of your net asset value is in the other 90%. The good thing is you're not selling any of that asset in order to borrow. You're letting that asset grow. And as long as it's growing faster than the rate of the interest rate, you're going to be fine. You're going to do well. So,
yeah, I think one of the things that this is part of the reason why real estate does so well, because people say, oh, well, real estate only grows at 2%. And it's like, I get that, real estate, but that when you talk about 2%, you're talking, you can look at this in a million different ways, right? But when you say 2%, you're saying 2% off of the total asset value. So if you're only levered 4-to-1, so you put down a 20% down payment or 25% down payment, technically on your money, you're making 4x, because you own that asset, but you only put down a quarter amount of the money. And so since it's growing at 2% of the total asset value, technically on your money, you're making 4 times that, because you put down 25 or 30% or what have you. So there's a sweet spot associated with, and this is what companies try to do, right? Companies will try to figure out the sweet spot of where, and a lot of people are like, oh, taking on debt is bad. And this is like, yes and no, right? Like if you are not necessarily very prudent with your debt management and you just let it grow till kingdom come, and also you have a bad year or something like that, or you get in a bind where you're too afraid to cut the dividends based off of what can happen, then yes, then things can get really out of hand and out of control really quick. But if you're only levered like 10 or 15% of your annual sort of income, it's going to act as a, it's the same reason why, for example, Apple was borrowing money and debt at 1.5%. when there were 0 interest rates, to be able to pay the dividend and to be able to do buybacks, because they were like, we're growing at such a pace that if we're able to borrow at 1%, we're able to buy back our own stock and basically offset whatever and be able to increase our returns by X. And it was actually pretty interesting how they were able to navigate some of that. Now, if you get a little bit out of control and you don't necessarily take it, the problem that I see with most companies is they have a really good year, and then they raise rates by raise dividends or buybacks or something like that by 20% that year. And it's like, well, you just screwed yourself for the next year, because not only do you now have to pay the previous year's 20%, but now you have to update and grow on that 20%. Yeah. And so for companies that are very cyclical industries, I see this happen all the time. Oil companies, there's one where they have a really good year. They're like, ooh, look at us. Like 2022, for example, really good year. People were throwing out buybacks and dividends like it was nobody's business. But here we are at a 40% decline in oil prices, going from $120 a barrel to $70 a barrel. And people are like, ooh, buybacks are getting stretched. And now you're looking at oil companies and people are like, I don't know if they can sustain this dividend. You guys told me you'd be able to sustain the dividend until $50 a barrel. And now you guys are saying, I don't know, we might have to cut and this and that. So you get into this cycle of a bunch
So
of
V is asking a really good question. So he said right there, how come you don't have to pay the debt back in your example, Chris? Well, technically you're going to pay the debt back, but you're going to do it when you die, right? So when you die, everything that you had, that you bought, let's say you bought Google in the year 2000, and that's appreciated by 50,000%. you will sell it and pay that debt right away. But the thing is, remember, when you die, everything gets stepped up in basis. So what ends up happening is now there's no capital gains taxes on any of that stuff. And instead it gets charged up to your heirs, and your heirs just pay that debt down. And literally it's like tax avoidance. Like there's no tomorrow. All the rich people do it. Like I'm not even gonna front here and tell people like, hey, listen, this is a legit thing that people do, man.
Yeah, man.
So, but the thing is, like, once you get to a certain wealth level, it becomes easier to do stuff like this. But I mean, this is definitely not a strategy that people utilize, like, just willy nilly. Like, you need to have some real serious assets. And so, what ends up happening is they just have like $100 million worth of assets on one side. They go to JP Morgan or Goldman Sachs and say, I want to use this as collateral to go invest. I mean, to go ball out. And they go ball out. They're like, oh, let me go enjoy myself, right? Mm-hmm. In which case now the assets are always growing faster than the money that they've borrowed. And eventually they'll have to pay it back when they pass.
It's not about screwing your kids. Like, and I know people are probably saying that to be as a joke, but to me, you get in this really weird situation. If you think about the traditional way that people think, right? Say you have $1 million portfolio, Chris, and you say, well, half of that is capital gains, right? So 500,000 to $1 million. So you have $500,000 in long-term capital gains. You say, I want to buy this house. So you sell this $100 million or this $1 million portfolio, and now you pay taxes on that $500,000. That's $100,000 that you now have to get rid of and pay to the tax man because it's a 20% capital gains, long-term capital gains tax, right? Yeah. Now you're left with $900,000 that you can use. When in reality, what you could have done is just borrowed some of that money instead of selling and being able to. You could have borrowed some of that money, used it, not had to pay capital gains tax, not lose that $100,000. In fact, you have now interest against that $100,000 in capital gains that you would have had to pay because you're paying simple interest on that. So you're almost getting that in benefit, and you can keep growing wherever you want it to be. Yeah. So my hope is exactly that. Instead of me being like, hey, Matt, my sister really wants to get into real estate. It's just the nature of the beast. She's going to be asking me, I'm sure, the next couple months or a year, I want to go buy this house in Outer Banks, North Carolina. Instead of me being like, okay, let me sell Palantir, I'm going to be like, you know what? I have enough SPY at this point where I'm going to move all my S&P 500 to this bank. And this bank will be like, yeah, sure, you can borrow it at 5 or 6%. And I'll take $100,000 from that, use it as the down payment. And even if I wanted to, I could charge her and be like, you're going to be paying me back half this down payment. And I could, get 50 grand back immediately and, pay myself back instead of having to pay some bank or something of the like. So I think it helps a little bit in that respect. It's not trying to be the thing that you need to recognize is, once again, it's kind of like margin. You have to be responsible. You can't just, if you have enough money and you're being responsible with it, you can go buy whatever you want. You can pay rent, you can do whatever you want. But like, if you're borrowing like 20-30%, I don't know if I would be paying rent and stuff with that, right? Like if you're paying like a couple percentage points with rent and stuff, like, I get it because you're living off of the portfolio and everything like, but to me, what I would mostly use it for, at least in the shorter term, is to make sure that I'm making money with whatever I borrow. Yeah. And so, the problem is as well is if sometimes you can't get loans from the bank specifically for down payments on houses. Sometimes you can, sometimes you can't, right? It depends on what, so if it's your own money though, you have the flexibility to do whatever you want. Sorry, I cut you off, Chris.
No, I was going to answer some of the questions that are in the chat. Like Gary says, Chris and Matt, we don't know this stuff because we come from working and middle class. So here's the funny thing. Me and Matt, we also come from working and middle class. Like I grew up poor too, but the thing is, like, I always wanted to figure out like what the wealthy do. Cause if you want to be them, you got to find out what they're doing. And these people are not going to actively come out there and give you seminars on, hey, are you middle class? Let's make you a wealthy person. No, the one thing that the wealthy love is making sure that the ladder behind them is pulled up so that you don't get to be in the same strata. So right now, I think we're a bit of class traders right now, Matt. We're giving away we're giving away all the secrets to how to game the system. And the thing is,
bit.
you want to know something? This is the thing that that Trump was not Trump, Chappelle was talking about. You guys remember? Let me see if I can find that clip.
Don't play the clip. We're gonna get demonetized.
Come on, man. What's the fun of it? We can't do that. Let me see. 1 second. We're not gonna get demonetized on this one.
Yeah, we are. I'm not letting you play it.
Whatever.
Give us the gist. What's the gist, Chris?
No, it's not gonna get demonetized. All right, it's fine. If we get demonetized, I'll give you $5. It's fine. Let's see. Let me play it. Share the screen right here.
Understand why Trump was so popular, but I get it because I hear it every day. He's very loved. The reason he's loved is because people in Ohio have never seen somebody like him. He's what I call an honest liar. At that first debate, I've never seen a white male billionaire screaming at the top of his lungs, "This whole system is rigged." Across the stage was a white woman, Hillary Clinton and Barack Obama, sitting over there looking at him like, "No, it's not." I said, "Now, wait a minute, bro. It's what he said." And the moderator said, "Well, Mr. Trump, if in fact the system is rigged, what would be your evidence?" Remember what he said, bro? He said, "I know the system is rigged because I use it." I said, "God damn." And then Hillary Clinton tried to push him taxes. She said, "This man doesn't pay his taxes." He shot right back. "That makes me smart." And then he said, "If you want me to pay my taxes, then change the tax code. But I know you won't, because your friends and your donors enjoy the same tax breaks that I do." And with that, my friends, a star was born.
Yeah.
That clip, because it's absolutely true. If you look at how our tax code is structured, all of this performative bullshit that Elizabeth Warren, all these people they come up with, they all do that to basically protect their wealthy donors, and also like wealthy people from basically gaming the system. That's why Jeff Bezos barely pays any in taxes. That's why Mark Zuckerberg. Do you know what Zuckerberg did, by the way, Matt, with SVB?
No. Silicon Valley Bank, what happened?
Okay, so Zuckerberg takes his money, puts it in Silicon Valley Bank, right? And then he takes loans from Silicon Valley Bank for like 1% and finances his homes and shit. Okay?
Oh, yeah,
1%.
Yeah.
Okay? Imagine right now, any of you guys in the chat that you were able to borrow to buy a mansion at 1%. But you know who was able to do that? Zuckerberg. Zuckerberg stock was going up every single day, faster and faster. But the money that he borrowed was barely going up. Why? Because he was getting this preferential tax. Now, here's the funny thing, though. When SVB collapsed, did you know how much money the Zuckerberg lost? Zero. All of the Silicon Valley got bailed out. Technically, when a bank goes under, you know, the FDIC is only supposed to cover up to a certain amount of money. The FDIC didn't cover a certain amount of money. They covered everything.
Yeah, they did. They made sure everybody was covered. But I think it's funny. I think a lot of people were like complaining back when when Elon was getting his big tax bill, or not tax bill, his big stock compensation the other day, last year, or earlier this year, whatever. And I don't think he actually cared about it for his own personal wealth. I think he cares about it because he uses whatever stock he gets to leverage into either buying more Tesla, being able to put that money into SpaceX, and that. He's not like Elon. If anybody that knows what how he lives in like a shack in Boca Chica. Like it's not like he's living the high life, right? And so it was interesting how people think he's like trying to be some sort of, like, he spends all his money in his businesses, so it doesn't really necessarily matter. But I agree, man. I think it's wise that people borrow against their stocks, and especially if they're doing well, you know, like I don't necessarily think it's a bad idea. That's where I want to be. I want to be in a place where I can just invest in the SP 500, borrow 5% for a down payment here, borrow 10% for a down payment there. And I want to keep a steady loan to value ratio. Like I would love to get to a 70% loan to value ratio for my entire real estate portfolio, maybe up to 65%. So that way I'm always, 3-for-1 levered. But if something bad truly happens in the economy, the bank's not going to be calling me, giving me a bunch of shit because my mortgages are underwater or something like that. Because very rarely would you ever expect real estate to go down by 30 or 40%, unless you're buying in a shit area or there's some sort of natural disaster, which is always plausible, but hopefully in that case, you're covered by some sort of insurance.
Yeah. So just one thing. So I know some people are probably going to be skeptical, like, hey, like this doesn't sound like it's a real thing. Now read up on it, man. It was on Vice right here with SVB. Like they even said right here, SVB also now struggling. First Republic, another San Francisco-based financial firm that famously offered Mark Zuckerberg a below 1% mortgage rate, would go out of their way to bank with us because they're blah, 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 blah. Right here, the bank's services were invaluable to venture capitalists. It would manage venture capitalist money, partners, personal money, and sometimes even invest in venture funds. The bank's venture arm reportedly had invested hundreds of millions of dollars into funds created by Sequoia and Andreessen Horowitz. Okay. So yeah, this is all the kind of shenanigans that happen in our background. And yeah, it happens. Let me see, mortgages right here. The bank services were invaluable. It would also offer short-term loans to funds, making connections to potential limited partners. And if all works out down the line, we might be taking out mortgages or using their wealth managers. So in order to drop the business, they would do that. So yeah.
Interesting.
Someone's asking me, Chris, what is your retirement number? I would say 5 million in liquid, not 5 million in total assets. Like if I get 5 million in liquid, I'm probably done working, but I'll probably never stop working. It'll probably be like quit my daytime. I don't really need to work daytime job anymore. Stuff like that.
Yeah. No, I mean, it really just depends. 4 million liquid would be nice because I'm at where I'm at now, but not all of it's liquid, right? Yeah. So like some of it's locked up in retirement accounts, some of it's locked up in IRAs, and so you can't access some of it.
So Matt, you know what's funny? I was actually looking, I've been looking in the market to buy a house. I'm still cheap. Man, I'm looking at some of these houses and I'm just like, how the hell do these people like afford all of this X, Y, and Z? And
they don't have money in the bank. Yes,
there's generational wealth. But it's shocking, like how much money it's actually out there. I'll tell you a funny story. This week, I went to Fidelity because I was trying to, like, we have a Fidelity branch by me because I wanted to transfer some of my assets that I have that have appreciated to my in-laws. And I actually had to do it in the bank. And I remember this one, like, really, like, just angry ass lady come in, and she was just like, I need this done. I need that done. Like, if you don't, I'm going to pull my X, Y, and Z money out from you guys and take it over to Chase right away. And the guy's like being super nice. And I'm just like, damn, bitch, just being rich doesn't give you the fucking privilege of being an asshole. But that's how people are, man. They get to that certain wealth level. They lose any sense of humility and they just become like entitled pieces of shit. And I'm sitting there the entire time and I'm just like, man, I'll never be like that person, hopefully. And if my kid ever tries to be like that or even thinks about being like that, hell no, cut you off right away.
Yeah. I going back to that piece, I think a lot of people only live in their homes. They don't have any money in the bank, because you'll be surprised how many people that I know that have $750,000, $800,000 houses. And I talk about the portfolio that I have and their eyes just blow up. They're like, you have this much in that stock. You have that much in that stock. You have 2 of those stocks. How? And it's like, because, a couple of these positions, my top 5 positions in my portfolio is probably the amount of their house value. Right. So it's like, well, I invested, I'm living frugally, but I think a lot of it also is they probably bought a house early. They're able to take that equity, roll it up, because you think about it, if your house is appreciating at $100,000 every 5 or 6 years, you're able to sell. Yes, you have to pay some to the realtors and everything they like, but now you have equity that you've built, and now you can buy a house that's, let's just say, $100,000 more than you did previously, because you now have that equity. Plus, hopefully, you maybe have a bigger down payment or whatever. So I think that's honestly what people do, and they really they only start focusing on retirement and having things in the bank when they're in their mid 40s, late 40s, when that time It's I don't want to say it's too late, but then at that point they're going to be forced to be working until they're 60 or 65. So it all just depends on what makes people happy, right? That might make people happy to have a big ass home, but I think a lot of times people recognize that they probably could have dealt with a smaller home and had a lot more to save and probably retire earlier.
Here's an interesting question. What are your top 5 equity holdings? So I'll give you one of them just right off the bat. Me and my wife, we both have massive retirement portfolios right now, and it's from our job, and I have a little bit from what is that thing from my solo 401k. So my main investment in those is something that tracks like the S&P 500 with a little bit of more active management. I don't know if you'd use this at all, but let me just show you. Is this right here? I use so most of it, like my wife's entire retirement is in this. My retirement is in this. It's not an index fund. It's a mutual fund. And it's actually one of the better mutual funds in my opinion. Like if you look like historically, it's gone really nicely higher. And if I looked at the contents and their companies that I would traditionally buy myself, right? As an example, this is the composition for these guys. It's large cap growth. So if you look at the companies, it's like 15% of it is Meta, Berkshire Hathaway, Nvidia, Microsoft, Amazon, Apple, Eli Lilly, Alphabet, Regeneron, and the portfolio, like I said, it's pretty good. But if you see on a compounding basis and you compare it against the S&P 500, like you can see that it's actually outperformed, one of the few funds that actually outperformed the S&P 500. And the reason why I do it in this one specifically is because, and not some people say, why don't you just buy VOO and you don't have to pay any fees and blah, blah, blah. Well, unfortunately, our 401s, especially the ones from our jobs, they don't allow us to choose anything that's outside of that. So this is the one that's the easiest for me. So, yeah. Look at that. This year especially, they've really outperformed themselves. Yeah. So you see? Do you use any mutual funds for your
small to see
for your 401k?
For 401k, the 401k is mostly just SPY. I mean, I mostly just do the S&P.
No, I'm saying like your job allows you to buy just straight SPY.
It's an S&P 500 equivalent that I think is managed by Goldman.
Gotcha. Okay.
So it's low expense ratio, but they have other things, like they have a real estate fund, they have small caps, they have target date funds, which I recommend everybody stay away from. Because it's interesting, and I just want to say this out loud because I think a lot of people are like, what do you mean stay away from? They say that you might be, let's just say 80% invested in large cap growth or something of the like, but take 80% of, let's just say you're in a target date fund 2060 or 2050, and it's 80% what you think is invested in equities or say comparable to the S&P 500 and 20% is in bonds. I dare you to take 80% of what SPY's returned this year and put that up against what you've returned this year. And I guarantee it's nowhere close. And because I think that there's so many underlying fees, the problem is they'll show a overall fee for the fund, but they don't have the underlying fees for each of the different things that you're invested in underneath. So what they have is they have an overarching fee of, let's say, 0.25 or 0.3%, but each of those funds that you're invested in underneath also has a fee. And so depending on who's managing that, whether it's a large cap S&P or a real estate fund, that might be 0.1%, that might be 0.2%, that might be, and so all these fees stack up, and I don't think people recognize that. So I encourage people to look, if you're really interested in kind of taking control. That's one of the biggest things. I showed that to one of my buddies at work one day. He invested in one of our target date funds. It wasn't like he was invested in the 2020 or 2025 target date fund where they're going to put you mostly in bonds because they're close to retirement, right? It was one of those ones where you're still at like 75 or 80.
Yeah, but the reason why they do that,
hold on, let me finish.
Yeah.
Is because and he looked at it, and the amount of return that he had over the past 5 years comparatively to the S&P 500 was like a third. And I told him straight up, I was just like, get your money out of it, just invest in the SPY. and he couldn't look me for 2 weeks because he was so upset, because he literally was just like, I just missed out on $100,000 worth of growth because he chose a simple target date fund that he thought was made for him by Wall Street because they have his thoughts in mind and his wants in mind. But in reality, they stack these things up to get more expense ratios.
Yeah, you know what? I'm going to push back against that, Matt. Yes, you're thinking of it as a total return perspective, but target date funds are specifically for that. As you get older, you need to be more conservative. Like the last thing you want to be doing is trying to put all of your nest egg into the S&P 500, and you're like 62 years old, about to retire, and the market craps 30%, and boom, 30% of your net worth just disappears, right? You typically want to be in more safe stuff. That's why you underperform the S&P 500 when you get older and older and older, because you don't want to take the risk. Like me and you right now, if he's investing in target dated funds, especially right now, probably not a good idea. But if he's like in his 50s, 60s, bro, that's how it works. The older you get, the underperformance you're going to get, but you're also going to be taking a lot less risk. You saw that chart that I just put, the S&P. Let's look at the S&P 500.
That's what I'm saying, Chris. This gentleman's 39. It's not like he's 55.
Oh yeah, there's a difference. Yeah.
Like I'm not saying anybody in here that is saying looking at the 2025 target date fund. I'm saying if you're 22 years old, it's the same reasons why I tell most people that are 20 something years old not to do dividend stocks, because they're chasing pennies and they're leaving dollars on the table most of the time.
Yeah. The reason why I say that is let's look at this chart right here. Okay. Let's say you were in the S&P 500 around the year 2000 and you turned 60 years old. You basically now every year, everything is going to keep going further lower and lower until you went from $150 to right now by 2003 to $89 per share. Okay. So you're already in your twilight years. You're not going to be able to contribute more money, and your portfolio is going to keep going lower and lower and lower, right? This is not the time where you want to be chasing higher return. This is where you're chasing safety and fixed and guaranteed income, so that this way you can survive until whenever you actually pass away. Same thing. If you look, the S&P 500, it comes with risks. If you're all of your money is in the S&P 500 right here in the year 2000, and the damn thing collapses to 77, and you lose half your money, you're 65, and you're like, oh well, look, the SPY is down. Eventually, it'll go back up. Yeah, but you don't have time, man. So I'm not saying that target dated funds are the greatest thing on the planet, but there's a reason for them, which is as you get older, you want to take less risk. Dividend people, just like you said, when you're younger, you shouldn't be chasing dividends. You should be chasing capital appreciation. But as you get older, it makes sense to be a little bit more like, hey, you know what? I need to be a lot less risky, especially if you're retired and you have no new income coming in. The last thing you want to do is put your money all in stock and hope for the best. Instead, you might miss out on quote unquote gains, but you'll also miss out on losses as well, right? Because you're in bonds, you're in a lot more of a safe environment. So, not to mention, by the time you get to the retirement, you should have a few $1 million, even at a 5% rate of return, and you have like $4 million. That's still $200,000 a year.
Yeah, you should be aiming the goal that people give out is 20 to 25 times your needed income.
Yeah.
So some people say just to put a buffer on it, they say 20 to 25 times your salary, your exit salary, because then at that point, let's just say you're making $100,000 a year, you have 2.5 million in the bank, a 4% yield is going to make you $100,000, and that's what you were making before, right? But if you're living below your means and you're saving and at a 30%, you're only using 70,000, then technically you have a little bit of a buffer, right? You're not going to be using 4% every single year. So the hope is that number comes from the rule of not the rule of 72, sorry, but the 4% rule, which now people are starting to say the 3.5% rule is a little bit better. But that 4% rule means, and generally speaking, this is, a rule of thumb. It's not necessarily, but they basically did a backtracking of retirement returns of the S&P and a couple other things out there of an average market return portfolio. And they said, basically, if you were to pull out 4% of your principal every single year, like Chris was showing earlier, if your portfolio is growing at 4 or 5% per annum, then you'll never run out of money. Even if there's a severe drawdown of say 20 or 30%, you know, you might have a little bit less money that year, but generally speaking, the market does recover within the matter of a couple of years. And so the hope is you're able to consistently pull out 4%. Now, my hope is personally for my portfolio is to get to a place where I could take out 3%. And if you're investing in the SPY, you're getting about 1.2 to 1.5%. And if you just write some covered calls very conservatively, you're not writing at the money, but you're writing very conservative, far out of the money covered calls, you can get 3% with that 1.5% dividend yield. So it's going to be pretty easy, you know, for you to retire. And that's another thing as well. Like I try to tell people, you know, if you think about it, say you have a 2.5% yielding portfolio, and you're like, well, I want to retire off these dividends. It's like, well, you know, say you need, I don't know, $25,000 a year. Well, you need $1 million. But if now, let's just say, for example, you're able to do some covered calls and make that 2.5%, 4%. Well, to get that same amount of money now, you only need $650,000 because you're able to write some covered calls and get that extra income, right? And you're still going to get that $25,000 a year. So it's all math. You just need to figure out, you know, how conservative you want to be and what your investment rate is every single year. A good reading for people that are really concerned about the retirement is The Simple Math Behind Early Retirement by Mr. Money Mustache. Or it's The Shockingly Simple Math by Mr. Money Mustache. And basically this talks about if you're saving 10% of your income, you're going to have to work 50 years before you can retire, right? Because you're saving so little. But if you're saving 30%, you're going to be able to retire in 15 to 20 years. If you're saving 90%, you're going to be able to retire in 3 years because you're going to be able to invest so much and you're only using. That's not to say you have to but you have to keep in mind, if you're saving 90% of your income, you can't go from only using that 10% to now all of a sudden using 100% of what you were making because, you know, that's just not how the math works. So
yeah, you know what's crazy? The compounding, man. The one best piece of advice that you could give is everyone, no matter how much money you have, start saving early. The way that things compound on themselves, the math is crazy, dude. For every like 5 years that you miss out on investing, you're missing out on like huge amount of gains. Let me see if I can find a YouTube video that has like that explained. 1 second.
Which one? Sorry.
Compounding. Let me just see. Hold on 1 second. Compounding. It's like the power of compounding where damn it, man. I can find a really good one that shows like how if you start early enough, you're going to do really good. I think this one's a good one. 1 second. This is something that I got to show my wife, actually. It's this one creator. She does a pretty decent job explaining some of these things. Let's just watch her real quick.
Right. The second thing that people miss is what they call, have you ever heard of the phrases, money makes money, the rich are getting richer, the more money you have, the more money you make? In this video, I wanted to take you behind the scenes to explain why phrases like this exist, why your net worth takes off at 100K, and give you tips on what to do to get around this 100K number and what to focus on instead. Let's start with the why. Why does your net worth explode at 100K? Many people believe that reaching a certain threshold suddenly grants you to exclusive access to better opportunities. And these opportunities mean better investments, which come with higher returns, and that is why the rich get richer. In fact, there are two other important factors that come into play as to why your net worth explodes at 100K, and neither of which are related to the type of investment you have access to. The first of those is the scale of capital. Let's first consider the reinvestments, different scales, all of which offer the same 10% return. So suppose you invest $1,000 with a 10% annual return. After 1 year, your investment would grow to $1,100, so a profit of $100. If you invest $10,000 with the same 10% annual return, your investment would grow to $11,000 after 1 year. Same percentage return, that same 10%, just a larger absolute number, so your profit is $1,000. And then looking at a $100,000 investment with the same 10% annual return would grow to $110,000, resulting in a profit of $10,000. The investment The risks, the period are the same in all three cases, but the profits are significantly different. Scaling capital allows for higher returns on a larger amount of your money. And as you increase the size of your investment, the absolute return also increases proportionately, which ultimately means you grow your wealth at a faster rate. The second thing that people miss is what they call the eighth wonder of the world, and that is compound interest. Compound interest is, put simply, the interest you earn on your investments. So with compound interest, not only are you earning money on your original money or the principal balance, but you also earn money on the interest you've already made through that original investment. It's hard to explain this without using numbers. So let's say you save $1,000 every month with an 8% annual average return. After 7 years, you'll reach a net worth of $100,000. That's quite a long time. That's 7 years to get to that first milestone of $100,000. But to get to the second milestone of the next 100,000, that time period shortens drastically. This time, you'll earn an 8% return on a larger amount. You will earn it on the first 100,000 that you've already saved, and you'll earn it on the interest that that first 100,000 has also accumulated. So as a result, the time it takes to reach the next 100,000 milestone reduces to 4 years, almost half the time it took to reach the first 100K milestone. And then to reach the next 100,000 milestone after that, it'll take you just over 3 years. And you'll notice that the time it takes to earn each additional $100,000 after that gets shorter and shorter as you have money working for you already, and then money working for that money, and then money working for that money. And then once you reach $1 million, an extra 100,000 from interest alone will take you just over a year. The hardest and the most time-consuming part is often at the beginning because you don't have compound interest working for you. So you have to do a lot of that heavy lifting yourself. And that's also why a lot of financial content for people at the start of their journey is based around optimizing every penny, cutting out those oat milk lattes, not buying XYZ, is centered largely around deprivation, because at this point, every small financial win may feel really hard and like it's not moving the needle much. But it's those small wins that when you put together gets you to that first 100K. Once you reach that, every success then adds up pretty quickly. And the further into the wealth building process you go, the easier it gets. So keeping these two factors in mind, capital scale and compounding, what are some of the things you can do to make sure you're not left behind if you don't have that 100K saved up? The first is to increase the amount.
Okay, whatever. She'll figure that out. You can figure out how to save your own money. But that's the point. Like sometimes when my wife thinks I'm a genius, and I'm like, no, I'm not a genius. I just started investing when I was early. So I was able to save, and now the money is making us more money. I still remember the first fight I got into my wife with was she was doing her residency in Jacksonville. And I wasn't even a boyfriend at that point. And I saw some of her like finances, and I was just like, what? What do you mean you don't have anything saved? What do you mean you have a credit card bill? And I was like, oh, no. You got to start putting money away. She's like, I don't have money to eat. Like, I don't want to do that. I was like, it's like, no, you'll figure out where you're going to cut some costs, but you're goddamn going to cut some costs. And you're going to start saving. You're going to start saving now. Now she's sitting on a 6-figure portfolio, and she's like, oh my God, you're so smart. I said, I'm not smart. All I did was tell you to put money away at a time where it made sense. 10 years later, you've got all this money because you gave up those small things at the time that seemed like they were important, but they weren't important. And yeah, it's great, you know. And that's the thing that sucks, man. When I see people like lose their jobs and they don't have an extra income to invest, it's like one of those things that like takes away so much return in the future. Like imagine right now you're 22 years old and you're out of work for like 3-4 years. Dude, you missed out on future earnings potential of almost $1 million those 2-3 years, because those were the years where you were making your prime working amounts, you know?
Yeah. So ET FaceTime sent me this basically to kind of show you and demonstrate what it looks like, right? So you might not think that it's a lot, but I mean, we're talking about going from pretty much zero back in the day to now being, you know, multi dozens of billions of dollars, right? Over $100 billion. And a lot of that came towards the back end of his life. And now it's actually 10 years beyond this. But of course, he's also giving away a crap ton of money. But it just goes to show you, you know, a little bit about what Chris is kind of referring to here, right? I mean, it's going to grow on top of itself.
Yeah.
Cool.
I think that's it today, man. I'm pretty much done. I think today this wasn't Cashflow Chronicles. This was like, I don't know, what do you want to call it? This is like good finance 101. This is the stuff they don't teach you in school. And they don't teach you in school for a reason. Because if you were, then you would be able to join them in the upper echelons. They don't want that. Yeah. They want to keep their club exclusive. You know?
Yeah, well, I will say, I mean, this is we helped above 200 people watching pretty consistently throughout the entire of the time. So really appreciate everybody. 200 people. It's the biggest chat we've had. So really appreciate you guys continue to tune in. Be sure to subscribe. It's completely free. Appreciate Julie becoming a member. That's helpful. All that money goes back into the portfolio so we can continue to show you guys more stuff. So anything else?
Oh, and one last thing. Just want to let you guys know, me and Matt, we have done well financially, but I come from a blue collar background. Fuck that blue collar. I don't even know what you call poor collar, or should I say like the coolie background. So like y'all are actually talking about blue collar and white collar. I come from no collar. I'm talking about like a wife beater and a t-shirt collar. Okay. That's where I come from. So I grew up poor as shit. So the thing is though, I changed my life thinking like, okay, what am I going to do to not be poor? And these were the steps that I had to take. It took them very early on. And my dad made some mistakes early in his life, which, were, believe it or not, those mistakes were the primary reason why I am so successful as I am today. It's because of his mistakes that I learned, and I chose not to make those same mistakes. And, it worked out well. And Matt, I'm sure that you come from a very, blue collar background as well, right?
I did it. Yeah, my family was okay. The thing that I was surprised about though is we were never really taught about money or anything like that growing up. And that thing, I think that would be very beneficial. And it was almost viewed as like faux pas. And when I first started coming home from school and college, and even when I started coming back from Texas and visiting family back in Pennsylvania, like, why are you investing in the stock market? Like, the stock market doesn't, that's the way to lose money. And so a lot of this stuff is all self-taught. And, I wish I had a little bit more of a mentor, somebody to help a little bit. But one thing that I will say is my uncle did tell me very early on, and I wish I listened to him a little bit more. He did really well in the early 2000s during the housing boom before the great financial crisis. And I think I talked about this on the channel before, but he told me, he said, Matt, he said, real estate is one good way to always kind of get you to where you need to go. And I didn't really think about it. The thing that I always liked most about the stock market is it was liquid. You didn't necessarily have to do anything with the houses. Like, for example, key thing, last night I was getting text messages at 10:30 at night because the Airbnb folks showed up late and they were like, we don't have the air conditioning remote. Well, my sister stupidly put them in a closet and locked it because she didn't think it would be 80 degrees in New Jersey in the middle of November. So anyway, we had to have like our cleaner go over and get it. But so that's the stupid thing associated with real estate versus like stocks. I could just wake up in the morning, sell it, do whatever I need to. But the thing that's beautiful about stocks or investments or assets in general, which initially I thought you could only do with real estate, but the more, I guess, money I'm able to grow and get, and the more I learn about leverage and doing things with creative finance, I recognized the things that I loved most about real estate was the leverage piece. Well, you can do the same in a smart way with stocks as well. But you just have to be a good steward of capital, right? A fool in their money is soup-hearted. So that's something my mom always told me when I was kind of growing up. So the thing that can be very useful and grow you very expansively very quickly can also go to zero very quickly if your attention kind of goes elsewhere. So anyway, it's just been a lot of fun to be able to teach myself this stuff over the past 10, 11 years. And hopefully I'm able to share and help you guys do something similar. Even if I'm able to shave.
What's our total return?
2 years.
Sorry, man. What's 2
years? Even if I'm able to shave off a year, 2 years, 3 years of somebody's learning curve, that's all that matters to me.
What's our total return in our portfolio so far this year? Let's see. Because if she was making she was counting 8% over the lifetime. Right now, what's our total return for this year? Let's see. I think you're muted, Matt. You're on mute. Mute. We're not at 100, Pedro. We're close though. I feel like no, we're not close. We're 70 something %, maybe. Let me see.
Yeah, year to date we're at 70. I'm trying to look at the whole. Why is this being? Okay, no, I got it now. So to date, this doesn't have our
Dog millionaire. That's awesome, dude. Love hearing that. Rob, what are you at? I'm getting Rob. Are you Rob the trucker? Sorry, or because I know I have a Rob in my Patreon. I don't know if you're the same guy. Are you the same guy? Can I grow up here? I'm Indian. But I just don't want to though. No, I'm not Rob the trucker. Okay, just checking in because there's a guy who's on my thing, Rob the trucker. So. Yeah, I know Raphael, bro. Raphael's been degenning into some plays. He's up 129% this year.
Sorry. Let me get back to this here. Exit, share. Let's make sure there's no account numbers or anything.
Yeah.
I think we're good. So this is total return. I'm still kind of a little bit confused because let me know if you can see it appropriately.
Yeah, 105%.
Yeah, so we've added 5,100. I think we started the account with whatever it was a year ago. Well, I guess this is a year ago, so technically, I guess there's some. But over the past year, we're up 105%. And for some reason, I'm like trying to understand this because when I went down here to November 2023, it shows that we're like at a negative 20%. But then at the same time, it looks at return here and it's only 20%. So I'm like very confused as to
how that could be possible.
Yeah, like why? But I guess this is
the way that the best way to do it is just look at your net deposits and what your current value is, right? So net deposits that we have is 3,261. Our total invested now, the total amount is 5,700. The thing is, remember, we were actively adding small amounts throughout this entire year. A couple of $100 here, a couple of $100 there. But basically, we turned $3,200 over the last year into 5,700. So yeah, which is good.
Yeah, not bad.
Yeah, go back to the old format. That's what what's his name is saying, because Fidelity has two things that you can see.
You're right. Yeah, new experience. Yeah. Does this have account numbers? I think we're okay.
So just to let people know, like let's say right now this 5,700 that me and Matt have, if you think about it, if we're able to generate a 10% fixed return for the next however many years, that's $570. That means that each of us is going to be making about $50-$60 per month passively for forever, right? And that's if we just use that to cash it out. Now imagine this portfolio. We're going to keep compounding it. We're going to keep compounding this sucker. I want to see how long it takes us to get to 100 million. Not 100 million, sorry. I was going to say 100
Me too,
million.
Chris.
No, how long it takes us to get to 100,000. I want us to get to 100,000,
Yeah, 100,000 is what we have always kind of.
So the balance that we started with was $500. So we started with $500.
Yeah, well, we started in October 2023, so technically this is a couple days old. after this point. But yeah, we grew it, and you can see the difference, right? So the balance is this darker blue versus what we've input, which is this lighter blue.
Mm-hmm.
So you can see by month, we lost money, I guess, in Jan 24 and April 2024, but every other month we've made money.
Yeah. That's good, man. And some of it's dividend income. You can see that's on the side that we keep depositing, and it's nice. It's nice.
Yeah, the hope is we get some sort of sponsorship or something with the podcast. And the real reason I care is eventually I would like to get it to the point where we're able to help people out and give some giveaways and stuff of the like. But for now, we're just trying to get to 100K, and then we'll see what happens after. So
yeah.
But yeah, I mean, shit, if we're able to grow at 50% a year like we did this year, I doubt it, right? But it'd be nice.
Who knows? Maybe we got it in us, man. Who knows? Dude, if we can get to, imagine right now, 2 years, 3 years from now, maybe 4 years from now, we're at 100K. We'll be like, remember that time we started this stupid thing and now we're at 100K? How cool would that be?
That's the hope, man. The hope is that people keep coming back week after week and are excited to see what we got. And
look at Joseph Carlson. Look at Joseph Carlson, man. Dude is absolutely killing it in this market. So,
Hot Joseph.
I say have a more concentrated portfolio, guys. See, there's two things that we're not going to do in this portfolio. Number one, we're not going to use leverage. Like, we could have really juiced up our returns had we gone into the options, but we chose not to. And the reason why is because I don't want to do risky shit in this one, right? Number two, overall, you don't want to teach bad habits. And one of the worst habits the person can get into is over concentration in one or two positions that could theoretically make you rich, but it could also destroy you if it's not the right one. And remember what we said, the most important thing is time. The last thing you want to do is have a $100,000 portfolio turn into a $50,000 one because you bought the wrong thing. And now you have to literally spend the next 4 years, 5 years saving up just to get back to that 50,000 again, So you don't want to waste time. And that's why we said, we just, like I said, let's see if we can do it, man.
I think we're doing okay. I mean, granted, It's a lucky year. It's easy for me to say, and play armchair quarterback and be like, look, you don't know what you're talking about. We're up 80% in this account. I'm up 70% in most of my personal accounts, 60, 70% in most of my personal accounts. But to be fair, we just, some of it's luck, some of it is smart, diligent work, but some of it is luck. And at the same time,
everyone's a genius in a bull market, right?
Yeah, exactly. And we had some things that lost money too, right? So you can't always, but it's easy to sit there and poke, but we put a lot of diligence behind a lot of these investments. And like Dutch Bros, for example, that's one that we talked about a lot last year. That one's done really well this year. I talk about Rocket Lab a good bit. Bitcoin's up pretty considerably since the beginning of the year. I've always been a Bitcoin bull. So, I mean, it's easy for me to point the finger when we're in an up market, but, we outpaced the S&P by a good margin. So hopefully we can do the same next year.
Yeah, agreed. All right. I think that's it, man.
Yeah, much appreciated, everybody.
Have a good one.
Thank you. Let's see here. Let's do a good one.
Greed is good. The stock is going to go up, down, sideways, or in fucking circles. It's all a fugazi.
Sell it all.
Greed is good.
Huge upside potential, upwards of 60